Members of AM Best analytical team will head north to Toronto this week and deliver a market briefing on Canada's insurance market. I'm John Weber for AM Best TV. Here to give us a preview of the event are senior financial analyst Anthony McSwieney and financial analyst Daniel Heitlinger. And Dan, can you characterize the overall performance of Canada's property casualty writers over the past year?
Yes, so PC insurers continue to be negatively impacted by volatile weather-related events, fire, and seismic activity throughout 2018. And this is paired with a volatile economic environment, as well as competitive and regulatory pressures that we see of impacting the company's bottom line. And then, when we look at Canadian insurers, looking back at the prior 10 years, we've seen the worst combined ratios in the past 10 years, and this is primarily driven again by those just hard weather-related losses and higher loss and LAE ratios.
What challenges do Canada's PC writers face down the road?
Yeah, so 2019 we note another troublesome year in terms of weather-related losses. What we'd recommend is a return to smarter underwriting and integration of greater data analytics that would help mitigate future losses and improve overall results.
Anthony, can you talk to us how Canada's life writers did over the past year?
Sure, John. Well, starting off, we affirmed our stable outlook for the Canadian marketplace. It's been stable, I think, for almost a decade. I would describe 2018 as a resilient year for the Canadian insurers. I say that for several reasons. One, when I look at it from a capital perspective, if you recall, last year we talked about LICAT. LICAT's in the rearview mirror for the Canadian life insurers. They've done very well navigating through that piece. It was almost a primer for what's coming up with IFRS 17. So from a capital regulatory structure, the industry is very strong. Following through to premium growth, the Canadian marketplace has shown improvement, growth in premiums on all their core products being life, annuity, accident and sickness, and the participation business. Accident and sickness probably has definitively had the biggest percentage, lion's share of the growth compared to the other lines, but they all showed growth, which is a good sign. That's supported by Canada's economic environment, which is pretty robust or strong at this point in time. When we look at it, the industry on a pre-tax income basis, they fared very well in 2018 compared to 2017. There were some headwinds in 2017 which hurt the industry, one being the DTA and the deferred tax asset on the U.S. side, which marginally impacted the earnings, nothing that we felt was a rating issue at the time, nor do we do now. But they came out through 2018 showing improvement there. And there were some headwinds, with that said, to profitability and pre-tax income. You had, when we look at net investment income, while it grew on an absolute term, it really grew on the back of higher invested assets. And there's still margin compression with the Canadian insurers. So there's that component on a forward-looking basis that we're concerned about. From a financial leverage perspective, the industry is continuing to rationalize financial leverage in a very stable and positive way. If I compare 2017 to 2018, I could see 2018 as a year where they marginally lowered their financial leverage view for the industry, which we view as very healthy, because a lot of the capital growth is coming in organically through earnings.
What issues will be at the forefront of your discussion in Toronto this Friday?
Yeah, so we do want to lead the discussion in Toronto with a couple issues that we feel are important going into 2019, and this is related to outside of our standard fare of rating topic issues at our annual meetings. We do want to have a more robust conversation around IFRS 17. IFRS 17 is coming up. It's going to be much larger than the LICAT issue. The industry is financially gearing up for it through allocation of capital, personnel, consultants, working with the regulators to meet the standards of IFRS 17. But the standards are large. You're looking at companies, Canadian insurers, changing their reporting requirements and standards under IFRS 17 more towards a policy type accounting method and reporting method compared to the pooled method done in the past. And that's a big challenge. That's not an easy thing for any industry to do. So they are in the process right now, or historically, of assessing those needs. We're looking forward to have a much more robust conversation on exactly where they are, how it's going to impact possibly their expense side, which is being beefed up despite improved earnings. They're saving in certain areas and kind of allocating towards IFRS 17. So we want a more robust conversation around that because it is a very large issue. The other issue is LIBOR. While LIBOR is due to change and to expire, sunset, and there's going to be a replacement for LIBOR. The industry, and this goes beyond the insurance industry as well, this is the broader financial market as well. There's over or approximately $200 trillion of contracts related to LIBOR, so its replacement is important. There's the indexes that are looking to be used to possibly replace it are everything from an unsecured market-driven index, possibly, to a more secured, federally secured type index. I think potentially we could be looking at multiple indexes as an option for the industry, banking, financial markets, insurance companies. That's yet to be determined. But our concern this year is we've been asking insurers over the past year, what's your view of LIBOR? What's the risk? Is there a risk? And they've been in the assessment stage, meaning they've looked at their contracts, they were gathering data. We'd like to get a better view on how big of a concern they view LIBOR is for them.
Thanks, Anthony. Dan?
Thank you.
You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.